In the TechFlow Solutions case, what combination of income statement changes indicated potential manipulation? A, revenue decreased while expenses increased. B, revenue increased 45-52%, while operating expenses dropped and gross margin jumped from 39% to 52%. C, revenue remained stable, while margins declined. D, only revenue increased without expense changes. The correct answer is B. Let's see why. Simultaneous revenue spikes, expense drops, and margin jumps are highly suspicious. What does a rapid increase in days sales outstanding (DSO) typically indicate in forensic analysis? Improved collection efficiency. B, better customer relationships. C, premature revenue recognition or collection issues. D, seasonal business variations. The correct answer is C. Rising DSO often signals premature revenue recognition or collection problems. TechFlow's gross margin improved from 35% to 52% against an industry benchmark of 38%. This represents a normal business improvement. B, a 14-point jump above industry average. Highly suspicious without operational justification. C, slightly above average performance. D, expected seasonal variation. The correct answer is B. Such a margin jump is a major red flag. In TechFlow's acquisition, the working capital adjustment calculation shows a seller owes buyer $370,129. B, buyer owes seller $370,129 based on the increase from the baseline of $2,263,578 to the closing of $2,633,707. C, no adjustment needed. D, working capital remained constant. The correct answer is B. The buyer owes the seller, but the increase may be artificially inflated. TechFlow's OCF to net income ratio declined from 0.89 to 0.49 indicates A, improved cash management. B, normal business operations. C, a classic fraud indicator. Profits not converting to cash. D, seasonal cash flow patterns. The correct answer is C. Profits not converting to cash is a classic fraud indicator. Based on TechFlow's integrated forensic analysis, the recommended legal action should include a minor contract adjustment only. B, fraud investigation, contract disputes, and potential criminal referral. C, no action needed. D, simple accounting restatement. The correct answer is B. Why? Because multiple red flags require comprehensive legal action. In the Toys R Us bankruptcy, what were the approximate recovery rates for each creditor class? A, secured 65%, unsecured 3%, subordinated 0%. B, all creditors recovered equally at 25%. C, secured 100%. Others 0%. D, recovery rates were random. The correct answer is a legal hierarchy determined these recovery rates. Under the clear method, TechFlow's reclassification of server hardware as it consulting expense would have, which legal consequences? A, only affects current year taxes. B, materially impacts financial statements, tax liabilities, and contractual obligations. C, has no significant legal implications. D, only affects depreciation schedules. The correct answer is B. Misclassification has broad legal and financial impacts. In the bankruptcy scenario with $1.02 B assets and $2 B debt split among secured $1.86 B, unsecured $2 Bs, and subordinated $2.05 B. What is the key legal principle determining recovery? A pro rata distribution among all creditors. B, absolute priority rule, with security interests. C, first come, first served basis. D, equal distribution regardless of seniority. The correct answer is B. The absolute priority rule governs payment hierarchy. Let's play a bit with true or false statements. A 52% revenue increase in Q4 2022 for a mature technology consulting business like TechFlow is a normal business fluctuation. The correct answer is false. Such spikes are highly unusual and signal red flags. In TechFlow's case, the 1-2% difference between operating income and net income in Q3-Q4 2022 indicates major hidden financing costs. The correct answer is false. Small, consistent differences are normal. Large or erratic gaps are concerning. According to the clear method, proper CAPEX versus OPEX classification only affects financial statements but has no legal implications. The correct answer is false. Misclassification can materially impact legal agreements and tax liabilities. Finally, let's play with multiple answer questions. Select all that apply. Which expense ratio changes in TechFlow's financials suggest potential misclassification? COGS ratio dropped from 65% to 48%. Operating expense ratio decreased significantly. Interest expense remained constant. The tax rate increased proportionally. The correct answers are: a COGS ratio dropped from 65% to 48%, and B, operating expense ratio decreased significantly, as both suggest potential expense misclassification.